Hey everyone, this is Robert Keens with goldsilverpros.com. I have a very special returning guest to the program, Nick Barisheff, the president and CEO of BMG Group up in Canada, who's going to tell us and give us his view on what's upcoming in the financial sector for 2021. Nick, how are you doing today?
Great. Thanks for having me on, Robert.
Yeah, a pleasure to have you on. Always a pleasure to interview you. You're one of the smartest people in the precious metal space,
Oh,
I think, and
I
that's
thought I'm just one of the oldest.
That's also David Morgan's opinion. Last time I spoke to him, you come highly recommended. So thank you for joining the program. I know we've had a very tumultuous 2020. A lot of things have gone on that we're probably not used to, and it's caused a lot of basically a risk-on environment in the markets. What are you seeing ending up 2020? What are your concerns going into 2021?
Well, I think we've got a good chance of getting back into the 2000 range by the end of the year, plus or minus. We've had a usual seasonal correction that's happened, pretty much consistently at this time. But at the same time, it was all in the paper comics markets, had nothing to do with physical, as usual. So that is continuing. When we look at next year, my concern is that the effects of all the lockdowns is what's going to surface and become obvious next year. So far, they've kept it patched over, they printed money and so on. But the thing you've got to remember is that they printed money to pay people not to work. Next year, they're going to have to figure out how to get everybody back to work and productive and boost the economy, which is going to be a major challenge. But the thing that could, in my view, and my background is as much real estate as it is gold. So I look at the real estate markets and you look at hotels, retail, office, and to a lesser extent, rental residential, and all that postponement and patching is going to come to a surface. Like there's already been a hotel in New York that was appraised at $360 million in 2019. The best offer they got for it was $60 million. So that means that the bank's taking a big haircut on the first mortgage even. Hotels are the most expensive real estate you can get. And, vaccine or no vaccine, I mean, the conferences, the conventions, all that kind of business is not coming back for a long time. So who wants to buy a hotel that has less than 20% occupancy? And that's the big problem in all the major cities. It's not the resort hotels, it's those very expensive convention hotels in the big cities. But then when you take that, when you first have no tenants, then you have the landlord fail, and then you have the banks with a big problem. And so the resulting problems that are already baked into the system are going to surface next year, and it'll go right through to the banks. And it'll make 2008 look like a party.
Yeah, that's my biggest concern right now is the effect on the banks. And I've said all year long, if the economy collapses, it's going to be a black swan in the banking system. I mean, forget about the shutdowns and everything.
The biggest vulnerability of the banks are like the mortgages, and particularly the commercial mortgages. When you look at the retail sector, the same thing. The rent payments have been postponed, deferred, and so on. Eventually, the landlords can't hang in. Now, if it's a major shopping center owned by the pension plans, they can hang in there. But if they're owned by private landlord, which many of the smaller centers are, they're not going to be able to hang on and keep making their mortgage payments. Office buildings, the same way. Like we had a conversation with our lawyer. They have 4 floors in one of the major towers, 500 employees.
Mm-hmm.
Well, they figured out that if all the employees showed up for work at 8 o'clock in the morning, it would take them till 11:30 to get upstairs in the elevators.
Mm.
You know, because you're only allowed four people per elevator, and you got to go up 50 floors.
Yeah.
You know, so it's these kind of things. The residential markets, they've deferred rents, and they've
Mm-hmm.
made it illegal to do evictions. That ends unless they extend it in January, and 10 million residential tenants could get evicted. 10 million. Add that to the homeless population, see what happens. So you've got these issues baked into the cake that they won't be able to hide any longer.
Mm-hmm.
And that's when you have a real estate decline, a stock market decline, and gold going through the roof as they print like 4 times the amount of money they already did this year.
Mm. Yeah, I think there was an article in Zero Hedge recently, and one of the statistics was there are something like 17 million people that are 6 months delinquent on their home loans. They can't
That's
pay.
right.
And this is as of December 31st. So what we could see in January is the banks start to basically foreclose. Do you think the banks will foreclose, or do you think they'll try to stall the inevitable? Because it's going to be an onslaught of foreclosures all at once.
Well, that's annoying, but it's almost futile because normally when you evict a tenant within some reasonable period of time,
Mm-hmm.
another tenant steps up to take over.
Mm-hmm.
But there's nobody stepping up.
Mm-hmm.
We go to a restaurant for lunch that we got to know the owner who happens to be the chef and the owner and everything. And for lunch, they used to have 100 to 150 people for lunch. Now they're only allowed 10, but typically we're the only ones there. There's like 2 or 3 of us. That's it.
Mm-hmm.
So sooner or later, they can't hang on any longer. And that's going to start surfacing and affect everything. Apart from the usual thing, the pension plans have enormous unfunded liabilities,
Mm-hmm.
which are going to skyrocket, except that probably they have less people to pay benefits to. That's all.
Right. You have that demographic issue, and then you have the issue of the government. What I'm predicting is right now, the U.S. government's meeting trying to pass more stimulus. So some of the CARES Act provisions passed this year are going to expire in December. They're talking anywhere between $900 million and $2 trillion. I don't think that's enough to stop all the bankruptcies and foreclosures. So even if they release that $2.2 trillion, which would be very inflationary for the economy, it's not going to stop a lot of what's going on underneath. So,
no, because like when you take tenants, for instance, so if you restart the stimulus, they can pay current rent, but they're already 5 months behind.
right.
So they can never pay the 5 months behind.
Yeah. So all they can do is just kind of kick the can down the road a few more months.
Right. And the other thing is that I think is going to happen in the working from home trend. Sure, everybody like to work from home, but in most cases, it's not practical. People don't have a spare room to dedicate as an office,
Mm-hmm.
and it's the kitchen table becomes the office,
Mm-hmm.
and then you've got both spouses sharing the kitchen table
Mm-hmm.
with the dogs, the cats, and the kids. So likelihood of work getting done is slim and none.
Mm-hmm.
And that's going to show up in the productivity.
Mm-hmm.
Already, in many cases, I find the phone is never answered, never. Okay, everybody's got a cell phone, so if you're going to work from home, answer the cell phone.
Mm-hmm.
Not answered, and emails take 2 to 3 days on average to get a response. So that's going to show up in gross productivity.
Yeah, and one of the interesting things at the same time that people are having to work from home, kids are schooling from home, and people that have young kids are finding it very difficult to get work done because you have a kid in kindergarten, you really have
Of course,
you have to be the teacher at home. How do you do that and work your job at the same time?
that's right. So they've created a giant mess.
Mm-hmm.
And, recently, haven't thought things through. And we've had pandemics before, SARS, swine flu, so nobody shut down the economy.
Mm-hmm.
And it depends on your reviews that this could be nothing more than a regular flu.
Right.
And, people with compromised immune systems, would be affected. There's no doubt about that. But we don't shut down the economy.
Mm. So what do you think that's going to do for the precious metal, going back to gold here for a moment? I know we had a little bit of a pop today, $28 up today in gold, but what do you
And
think long term that's going to do in
well,
2020?
I think it's going to continue because the primary correlation isn't the equity markets tanking. Gold. If you have a precipitous tanking, then gold will initially tank as well and then be the first to recover.
Mm-hmm.
But the main correlation is the correlation to U.S. debt, and U.S. debt because it's the world's reserve currency. So as the debt increases, it devalues the dollar,
Mm-hmm.
and it looks like gold's increasing, but it's the dollar that's devaluing.
Yeah. One thing I also noted, an article came out depicting how much money the U.S. Treasury have right now as of November 25th. Let me see if I can share this on the screen. Here's a current Treasury account statistics at the end of November. And this is in millions, so there's $1.6 trillion sitting on the Treasury's books that
Right.
they're going to unleash on the economy here in 2021. So this is money,
Right.
yeah, already on their balance sheet that hasn't been spent, that
Mm-hmm.
hasn't been baked into all the estimates of how much money is going to be in the system. Of course, you're going to have the Fed print more money too. What kind of money tidal wave do you think is coming in 2021 from the government?
Well, I think it can be anywhere from 4 to 6 times what they printed in 2020.
Mm-hmm.
You know, because like I say, that no, normally you measure that from a point of view for every dollar spent, and you get at least $1 in GDP growth.
Mm-hmm.
And we spent it to pay people not to work, so there's zero GDP growth,
Mm-hmm.
but a whole lot of debt.
Mm-hmm.
In if you go back like 10, 15 years, you'd go in debt for $1 and you get $4 of GDP growth.
Mm-hmm.
Then it's kind of justified. But now this just purely inflationary. But the real risk, and this is where uh, gold does well, people don't think so, is in a deflationary or stagflationary environment.
Mm-hmm.
Gold does even better. They can, you know, massage the numbers about inflation. John Williams thinks it's about 8 or 9%, not 2. So you've got those kind of numbers, but stagflation and deflation are much worse for the banks.
Mm-hmm.
And gold actually does better in a deflationary environment than an inflationary environment, as counterintuitive as that sounds.
Mm-hmm. And why is that, do you think? Is it because all the other asset classes are crashing because they're dependent
Yeah,
upon?
that's right. They're crashing by more. Like gold would also not rise, so it doesn't look like it's doing anything.
Mm-hmm.
But you can buy a house of BMW for half price,
Right.
if you have gold. So it does well. They did a very extensive study by a guy called Jastrom of the deflation in the UK. I think it was in the 17 or 1800s,
Mm-hmm.
and in the book's quite a thick, difficult to read book. But anyways, he concluded that gold does better in a deflation than in inflation.
Mm. Yeah, that's the research we had in my book too that I wrote 10 years ago. I looked at the gold standard. I looked at gold as money, and I looked at the fiat money standard.
Right.
And gold holds up no matter what environment. And I put it in a big table. It takes like 3 or 4 pages of my book, and it was all from the Minneapolis Fed. It was all the data from the Fed on inflation in the dollar, and in inflation and prices when we had gold trading alongside the dollar. And gold always does better no matter what environment, particularly in times of war or in times of big deflationary issues like recessions or depressions. Gold always outshines it. And that's information straight from the Fed. So reputable
Well, it's basically
sources.
because during those times, in a pure fiat currency system, the government prints way more money than they should.
That's right.
And I would say as well, if someone gave you a printing press that would make perfect counterfeit dollars, wouldn't you use it?
Of course.
So that's what the government does. And there's
Right.
never been a fiat, never, ever in the entire history of the world has there ever been a fiat currency that didn't end in hyperinflation. Never. We've in our boardroom, we've got a big poster. There was 60 countries that had hyperinflations. So I found a store in England that sold old paper currencies. And I bought the highest note in each of those countries
Mm-hmm.
and mounted on this big board and put a gold Arias in the middle.
Mm-hmm.
So the gold Arias is increased, and these pieces of paper were about $1 to $1.50 to buy the original $1 trillion notes.
That's right.
And when I gave it to the guy to mount to do the framing,
Mm-hmm.
he says, "Well, are you sure you're okay to leave all this money with me and you're going to trust me with it?"
Well, that's because money, paper money is basically an IOU of a debt system, right? It's not actual value. It's an IOU. We're going to pay you at some point in time, but in reality, we're just going to print the hell out of these. So each one of them is going to become
That's right.
only worth
And
the ink and
it's
the paper.
very subtle for most people.
Mm-hmm.
You're busy working, putting food on the table, and
Mm-hmm.
who has time to study this? It's only because we're in the business um, that forced us to look at this carefully.
So if you'll talk a little bit about gold in a portfolio and how it stabilizes a portfolio, because you had a really good, I believe last month, you had a really good article on that in terms of how gold can stabilize your returns in a portfolio. You want to speak about that for a moment?
So if you go to the World Gold Council website, they've now created a calculator
Mm-hmm.
that you put in all your portfolio components and put whatever percentage you want to have of gold and so on.
Mm-hmm.
And it gives you all the metrics to calculate standard deviation, returns, et cetera, et cetera. So basically, and we've done this the hard way using Excel files.
Mm-hmm.
But basically, it comes down to today, in today's environment, you need at least 20% physical bullion allocation to stabilize the portfolio.
Mm-hmm.
And the reason it does that is the 10-year returns, which surprises a lot of people in US dollars, sorry, not the 10-year, the 20-year returns
Mm-hmm.
in US dollars have averaged about 11%. Now, most pension funds target for 6% and don't get it.
Mm-hmm.
So 10% and that's basically in a manipulated market that still did 10%. Now, in addition, which makes the portfolio better is that it's either non-correlated or negatively correlated to stocks and bonds,
Mm-hmm.
depending on the conditions. So it improves the return and lowers the standard deviation. If you separate the standard deviation, the way you should,
Mm-hmm.
is to separate it between upside deviation and downside deviation, it looks even better.
That's right.
Because no one cares about measuring upside standard deviation. That's return. But downside deviation, you can say that could be equated to risk.
Right.
So and even if you use overall standard deviation, adding gold at 5, 10, and 20% will improve the standard deviation and the return. It's that simple.
And it really has nothing to do whether you're a gold bug or not. It's just gold really stabilizes portfolios,
Yeah,
increases returns over time.
yeah. And that's like a historical fact. Is you can have whatever opinions you want, but that's a fact.
Mm.
Okay, run the numbers yourself. Go to the World Gold Council website. It's free. Stick in your portfolio. Play around with how much gold, and you'll see the results. That's simple.
So you mentioned that gold returns about 10 to 11% over time. And you also mentioned earlier John Williams of Shadow Stats, who does the alternative calculation on inflation rates about that rate, isn't it? About 9 or 10% a year. So isn't gold just reflecting the inflation rate of the currency?
Yeah, that's what it typically has done with short-term fluctuations that have been due to paper manipulation.
Mm.
You know, but once you take it over, like say 20 years from 2000, then you get a pretty steady return. In the 20 years, I think there was only one year that had a 20% hit.
Mm.
That's it out of 20 years.
Yeah. So on the subject of manipulation, I just did a show on that Sunday night on the CFTC and how they can't regulate the markets, which they admit in the staff paper. That was one of the revelations on my video.
Right.
But manipulation seems to last in the short term. What's your view long term on manipulation? And does that affect your position on whether you should own gold and silver?
No, not at all, because when the manipulation ends, the gold price pops like holding a balloon underwater.
Mm-hmm.
Okay, but that's not the reason you're investing in gold. So, are you that unhappy with 10% returns every year while you're waiting for the manipulation to end?
Mm-hmm.
Like, really cares? That's a bonus, and
Yeah.
eventually it will. There's three methods of manipulation. There's the COMEX paper markets,
Mm-hmm.
and the main problem there is they allow commercial to do unlimited naked shorting.
Mm-hmm.
Okay, so they want to drive the price down. They can sell as many paper contracts as they want. If you and I tried that, they wouldn't let us. We'd need to have physical backing. Okay,
Mm-hmm.
that's one level of manipulation. The second level of manipulation is when the bullion banks borrow gold from central banks.
Mm-hmm.
The first book I read was Frank Benarusso's book in 1998.
Mm-hmm.
And at the time, he estimated that out of 32,000 tons of central bank holdings around the world, 8,000 tons were out on lease. He updated that report in 2002, and I think it was 22,000 tons were out on lease out of 30.
Oh my goodness.
So that was in 2002.
So is this all the gold that's flowing into the GLD, do you think?
Well, a lot of it is. That's the third level of manipulation.
Mm-hmm.
Because a lot of people think, well, the GLD is just like an open-end mutual fund with low management fees. No, it's nothing like an open-end mutual fund.
Mm-hmm.
Authorized participants contribute a defined basket to an ETF. In the gold ETF, it's a 400-ounce bar.
Mm-hmm.
Okay, now you have to think about Goldman Sachs or JP Morgan isn't going to go to the market, pay spot price for a 400-ounce bar, contribute it to the GLD, get newly issued shares back, and sell those to the public at NAV, okay?
Mm-hmm.
Because there's no money in that, okay?
Right.
That's circular transaction.
Right.
They borrow the gold from the central bank, contribute it to the GLD, they get shares, sell the shares, and keep all the money.
Mm-hmm.
So you have a liability at the central bank, and you've got the cash today, which the game used to be simply buy treasury bills at 4 or 5% because your gold lease was a half a point.
Mm-hmm.
So you don't need to be a genius to figure that one out. So that's the mechanism in the GLD, and you have to carefully review not only the prospectus, and you have to look at the authorized participant agreements very carefully. And the main thing is that the prospectus isn't what a normal prospectus is. There's no rules as to what you write up. It's not like a prospectus for a public company.
Mm.
They can do whatever they want.
So what do you think happens to the bullion banks when they get found out doing this? Are the central banks going to come after them?
Banks. The bullion banks, see, when you lease gold, title stays with the lessor.
Mm-hmm.
Just like title, if you lease a BMW, the title stays with the lessor.
Mm-hmm.
So the gold in the GLD is still owned by the bullion banks.
Mm-hmm.
But when they redeem it and sell it, they don't pay back the central bank. They ship it to Switzerland. It's converted into kilo bars and sent to China, and it's never coming back. So the problem becomes is if an authorized participant ever becomes insolvent, like Lehman Brothers nearly did, the central bank says, okay, well, boys, let's have the gold back. Okay. And then if the GLD ships the gold back, because it's not theirs in the first place, then the GLD investors lose.
So who's liable for that scheme when it breaks down ultimately?
The bankrupt authorized participant. So good luck with that one.
But they're bankrupt at that point in time, so good luck getting anything out of it.
Exactly.
Would anybody go to jail, do you think, that's running those authorized participants?
They didn't in 2008, did they?
No, they did not. So I guess fat chance of that happening. That's one of the things we talked about on our last video, Nick, was the differences in title process between real estate and gold. In real estate, it doesn't move. They drive stakes in the ground. So you know where the markings are. You have warranty deeds going all the way back to the land grants, at least here in the United States, that you can trace. Title companies, of course, offer title insurance on that.
Well,
what's the difference in gold? What's the difference in gold? Can you track gold? Yeah.
And a lot of rules associated with title. And yet when it comes to gold, in many cases, and it's as much as people's houses, yet people don't think, well, do I have title and what do I need to do to have title? And nobody hires a lawyer to pay them to certify title. All these kind of things. They're just taking people's word for it that it's there when it may be there to look at, but it doesn't, who's the owner? People don't ask that question. Like a lot of people have said, well, I've been to the vaults and, I see all these piles of gold. Whose is it?
That's a good point. And that's one of the things, the chain of title, that's very difficult to track too. Let's say you have an audit at a depository. Do they have the right to audit anybody else who's touched that gold up into that point to prove that it hadn't been remelted? And
well, the audits are difficult because not only do you have to count the physical bars and identify them all, you have to track the paperwork and get undertakings that you really own it. So when I started our funds, we probably spent several $100,000 to make sure that the funds had legal title. And I was used to that because of my real estate background. So it was kind of, I was thinking in those lines that, when you sell a multi-million-dollar commercial building, it's a big elaborate process to ensure the buyer gets clear title.
Very difficult to do in gold. So a lot of the gold figures around the world could be inflated. We don't know who may have original title to that gold. We don't know how many's gone back through, Switzerland to be repoured and new serial numbers on it. You have to be careful. So what are the safeguards of that? What do you look for if you're storing gold somewhere? You don't want to put it in your house. You want to buy it and store it somewhere. What do you look for?
You still have, like we have, if you get gold that you're going to be storing yourself, then you're not that concerned about it. You've got possession. But the thing is that we have in our bullion bars program, we've got probably over a dozen investors that have more than $1 million. Not a good idea to store that in your house.
No.
Okay. And the reason being that you typically won't be able to keep it secret enough. And one day you're going to face a home invasion, which isn't pleasant. So other than a few coins, keep that at home, but the rest you need proper custodial storage, where the legal agreements and the transfer of title, all those steps are taking place. That's the critical thing. Simply, it's not practical to do large quantities. Certainly for institutions, it's not practical. So oftentimes for our investors that hold $1 million worth of physical gold and silver or more, they might buy a box of silver coins that's like 500 coins, and keep that at home. But anything past that, it's not a good idea.
So what types of funds and storage options does your company offer?
Well, we've been, the last 20 years, we've been using Scotia Makata exclusively. And they're one of the oldest bullion dealers in the world. And they used to do about 4 times the volume of all the Canadian banks combined. So it was like no contest in terms of who to choose. So we were just careful that every time we bought gold, we had the paperwork tracing the purchase of that bar went into storage. They give us monthly reports on our website. We've got a list of all the bars that are held on behalf of clients and so on. Scotia earlier this year announced that they were getting out of the business, and we're negotiating with another major bank. Like for a mutual fund, you have to have a bank as custodian.
Okay.
For the bullion bars program, we have a relationship with Brinks, and they have storage at the in the right countries all over the world, so we can accommodate you in that respect.
Okay, Nick, last thoughts on this video. Any last thoughts on 2020 or the risks we see going into 2021 that you wanted to share?
Well, I don't like to be a doom and gloomer, but I'd like to face reality. So next year is not going to be a pleasant year, regardless of what happens to COVID, and regardless whether it's Biden or Trump that ultimately, becomes president. All the problems are baked into the cake. They've already happened. Companies either already bankrupt or they're going bankrupt. People are already out of work. That's only going to get worse.
For people watching this video, Nick, who are interested in getting a gold and silver, maybe they just found this video and been doing a little bit of research. How much time do you think they have to go ahead and take a position before maybe perhaps we have shortages or maybe the price gets too high? What are your thoughts on the timelines people have left?
The shortages that have been experienced in my career have been only coins. So if you're thinking of buying Maple Leafs or Eagles and so on, those could be shortages, and they're largely due to production. The shortages coming into the bigger London good delivery bars would be if the pension funds get started. Okay, like there's only 4 pension funds in the world that have bought gold. One of them we've sold, like a big Canadian pension fund. But the pension funds, what's the number? 340 trillion, is that right? In assets under management and no gold.
Right.
Yeah, so you figure out if they decided they needed a 20% allocation or even a 2% allocation, where is that gold going to come from? If that happens, then you've got a problem buying it.
Right.
And so I think sooner or later that will happen.
I agree with you. As the problems become more prominent and more in your face, the big funds are going to move in. I think we see it on the COMEX. I think we see big entities going through the COMEX, but that's just the leading, maybe percentage point. But a lot of the big funds, the retirement funds, the pension funds, hedge funds really haven't gone in physical to the market yet.
No. No, and we've been trying to promote that to the pension funds and so on. But it's basically like pulling teeth, because that's not something they ever considered.
Yeah.
And getting them to even consider this and analyze it is like pulling teeth.
Well, maybe as we get more negative interest rate bonds around the world, they'll stop buying bonds where they have to actually pay to own them, and they'll get it into gold. I wonder when they'll figure this one out.
Exactly.
All right, Nick, thank you so much. I appreciate it. You've been on the show several times this year. I've greatly appreciated you having you on the show and you explaining it to us, the mechanics of how the gold market works.
Okay, great. My pleasure.
All right, look forward to having you on again. Till next time, this is Robert Keens of goldsilverpros.com.